I haven't talked about this that much, but I used to be struggling with trading a lot. But everything changed when I found about market structure strategy. Because market structure always moves in a certain way, and now I actually understand how it moves. But the thing here is, it was hard to learn because most of the YouTubers, traders were explaining it in a hard way. But once I actually understood about market structure, that is when everything changed. And I've been profitable for a long time now. And I think it's only right if I explain it to you in a way that even a 5-year-old could understand it. So if a 5-year-old can understand it, then you can too. So all I'm asking you is to focus. Say to your brain right now that I will focus on this video and I will be hyper focused, okay? Then only I can guarantee you that this video will change your life. So like I told you, I will explain it to you in a way that even a 5-year-old could understand it. So I will explain it to you in a drawing first, and then we'll move on to the charts, because drawing is such a good way to explain it and you can understand it easily. So the first thing you have to understand about market structure is that the price never moves straightly up or down. Price always moves in 3 kinds of ways. Uptrend, in a trendy way, as you can see it's a wave, or downtrend, wavy way. As you can see, it never moves straightly up or down, it moves in a wave, as you can see, in a trend. Or the third thing is sideways. Literally, this is the worst kind of part. This is the worst kind of way it can move, which is consolidation. And this is when you shouldn't necessarily trade. But this also has a reason why it does that. Because there are equal amounts of buyers and equal amounts of sellers. So the price doesn't really know where is it going. And so it's going to do this consolidation where it just moves sideways. And this is most likely what's going to happen when you look at the charts, because this is actually 80% of the time, literally, consolidation, not that good. This is the best time to look for the trade, when it moves in a trend, when there's lots of volume, when the price actually moves. So this is when you should look for the trade. But obviously you have to understand that when the price moves like this, for example, in this case, uptrend, like this, higher highs, higher lows, higher highs, higher lows. Obviously, the price cannot move like that forever. It has to switch the direction at some point. So when the price breaks structure like this, then we will have to wait to see, does it want to continue the trend? And if it does, comes back here and breaks structure again, we can see that the trend has continued to the downside like this. But I'm going to explain you exactly why does that happen. So knowing when will the price switch its direction is actually pretty simple, but we have to understand this first. Why does the price want to move? What tasks does it have? First of all, price seeks out liquidity. It has to fill a lot of orders. These big banks, institutions, and hedge funds, they need to fill out a lot of orders in order for them to make money. So when the price moves in a trend, it seeks out liquidity to take because they need to fill orders. So when it sweeps out higher time frame liquidity like this, liquidity area, this is a liquidity area, and it's completely sweeps it. And then we see the break of structure, then we know, okay, this is a good sign because it took out a lot of orders and the banks already did the task that it needs to do, which is take out liquidity. And then when it breaks structure, that's when we can start looking for short opportunities in this case, because took out liquidity, we saw a reaction, and boom. But guys, this is a double-sided coin. Do you feel me? Because if it's in a trend, uptrend, and it breaks structure, it may just continue up. But also, when the trend is going up and there's a liquidity sweep, it also may just going up again after that. It's a double-sided coin. But when you see a liquidity that gets swept, we see it reacts from that, and we see a break of structure. That's when we know the trend will switch, as you can see, and here it will continue to the downside right here. And also in the opposite direction, if it moves straightly down like this is a downtrend, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. If here is higher time frame liquidity, for example, it gets swept and then it reacts from that immediately and it breaks structure, and then most likely what's going to happen almost every time, if it's higher time frame liquidity and break of structure and rejection, it will continue the trend to the upside, and that's when we enter and make money. That's literally what happens most of the time when I take my trade. So if you look at the chart, we can see that the trend is currently, at this point, it was bearish, okay? Lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. And what happens, guys? It's completely switched the trend. But why did that happen? Why did that happen? Because if you look closely, we can go even to the 1 hour time frame. We can go to the 1 hour time frame. We can see what happens. This is a draw in liquidity that got swept because, like I told you, these big banks, institutions, and hedge funds, their main goal is to take out liquidity. Liquidity is like liquid cash that they're seeking. It's lots of buy and sell orders, which we can find here, which is like these big candles. And what happens, guys? It gets swept. Immediate reaction from that. We can see that it hits it, it taps into it, and it immediately reacts from that. What happens then? In this case, because it's such a high time frame liquidity, we could go to even a lower time frame, such as 50-minute time frame. What would happen? What would I do? We can see it actually reacts from that. We can see that the trend is forming up to the upside. And here what we see, this is a break of structure right here. This is a break of structure to the upside. Right here, break structure. And what happens? It also closed above this lower high. A lot of reaction. We see rejection from the liquidity sweep. We see the trend forming up. And what happens, guys? The trend has switched. And here we would have made a lot of money. Okay? And this is another example. What happens here? This is obviously a bullish trend, as you can see. Higher highs, higher lows, higher highs. What happens? Why does it all of a sudden switch the trend? Because if we look closely, what happens here? This is also a liquidity. There's a lot of liquidities here, but this one example, this one got swept, immediate reaction, and if we go to the lower time frame, such as 5-minute time frame, we can see right here it actually broke structure, and we see the trend forming up. Here is consolidation. This is the consolidation, what I meant, like it's moving sideways. But as you can see, it actually switches the trend, and here it will continue the trend to the downside. Boom. This is a trend, as you can see. And I know this is a lower time frame. It looks kind of weird, but this is still a trend. As you can see, it does the same thing. And if we go to the higher time frame, we can see it's the exact same thing. Look, lower lows, lower highs, lower lows, lower highs, lower lows. And here, right now, it's kind of low volume, as you can see. But here, it was a market session open. New York Stock Exchange open was around here. It's in my time. And actually, I took 2 trades yesterday, Monday. So I took 2 trades, as you can see. First short, and this is the second trade. And I also traded it live. This is just a signal chat. But there's also a recap from the trades that I took. But that was just one example, and I want to just prove that this actually works. It actually works. It happens every single day. Every single day, the market structures move the same way. Okay, but that was an example of a market structure shift, which was a break of structure after the liquidity sweep. That was one example when the trend switches direction. But I want to show you one example too. If the market is moving all the time up, like for example in this case it's going up, bullish uptrend, right? Higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. Let's say here's no liquidity around, it's just moving up. You're like, what can I do now? It's not gonna switch direction anytime soon. What can you do? This is a great opportunity to look for buys, because if it moves up like this, we all know how we know how does the price move, like this. In an uptrend, higher highs, higher lows. When the price comes back, and it will, because the price needs to fill orders too, not only from liquidity sweep, but also from the imbalances that the price will create. Because when the price moves straightly up, it needs to come back to fix itself, to fill more orders here. So in this case, it will come here, continue the trend, but we do not immediately enter, because it actually may switch the direction all of a sudden. It can do that. But when we do know it will react from the imbalance, it will come back. We see a mini reaction and a break of structure on the lower time frames, and then we can know that the trend will actually continue and do the same thing all over again. And that's when we make our money. And I'm gonna show you the other way too. When it moves in a downtrend and there's no liquidity around, we can see that the trend is moving down. and you're like, oh, I want to enter. Well, when it creates these gaps, it's actually called a fair value gap, ICT concept. But when it creates these imbalances, when it comes back to correct itself, the price, we can enter from here when it gives us more reaction, and then it will continue the trend. Do you feel me? And that's how we make our money, because trend is your friend, yes. So how can we spot those in the charts? Well, it's actually really, really simple, because the price, we all know how the price moves. We all know how the price moves, right? We know that the price moves in a trend. In this case, what happens, guys? What happens here? This is a downtrend, right? Downtrend forming up. Clear downtrend forming up. What happens? Look at this, guys. What is this? This is a big candle. It is a big candle. Here's a gap. And as you see, the price needs to fix itself. Inside this gap, there's this imbalance that we need to take from 3 candles. It is created from 3 candles. It's called the fair value gap ICT concept. There's the 1 candle and the gap, and there's the 3rd candle. And it leaves us this gap that these banks, institutions need to fill, because the price needs to move in a trend. As you can see, it comes back and then continues the trend. But obviously we cannot immediately enter, because all of a sudden it could switch the direction. In this case, we could go to a lower time frame, such as 5-minute time frame. As you can see, it comes back to the fair value gap, the imbalance that which is marked out. This is a lower time frame. It hits it, and we see confirmation, break of structure, and it just continues the trend. As you can see, it continues the trend. That's how the price moves, always. So this is the key point of the video again. Price never moves like this. It never moves straightly up or down. It always moves in a trend. Higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. Downtrend, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. It is so important to know this, because when you know you're in a trend, you can start looking for trades inside these imbalances, because you know that the price will come back to those at some point, and then we can start looking more. And here's imbalances. Or when you know it's in an uptrend, for example, or downtrend, here's the higher time frame liquidity that is big banks need to fill. Sweeps it, and you see the liquidity sweep, and you see the confirmation, the break of structure, and it will continue the downs to the downside. Okay, switch of the trend. But trend always moves in higher highs, higher lows, lower highs. Or the thing that we don't want is the consolidation, when there's equal amounts of buyers and sellers and the price doesn't know what to do. So that's when you shouldn't trade, but you should trade when there's the uptrend or downtrend. If you want to know precisely how to spot those gaps, those fair value gaps, those imbalances, and how to spot the break of structures, like I just told you, or more about trends, then go to my YouTube channel. You have to understand those so you can actually master the market structure. Because if you actually master the market structure, you are unbeatable. Okay, but make sure to join the free trading community, and as usual, I will see you on the other side.